Hello everyone, this is Professor Kent and today's recording is homework for chapter 1. We're going to do 2 problem questions and then we're going to go move on to chapter 2. So the first question that we're going to do is problem number 1. Again, I'm using the book that I'm using in the classroom, which is Modern Advanced Accounting. So that's the book we are using, so that's the book you should be using too. Or you don't have to use a book, you can just follow the example that we have. The first thing we had to learn how to do is, or we already learned how to use is how to calculate the ratios. So we are going to do the current ratio, the debt to equity ratio, return on an average assets, and return on an average equity, only for the year 6 and for the year 7. So in the question we are given year 5, year 6 and year 7. From there we have to complete part A. So if you're doing part A, I am going to put it at the top is year 6, and then we are going to do year number 7. And the first one is asking you to do a current ratio. Before we do the ratio, of course, we needed to know what the formula is for the current ratio. Current ratio is your current asset divided by your current liability. So if we're doing year 6, my current assets are 560,000 and my current liability is 390. So my top number is 560,000, my bottom number is 390,000. Going forward to the year 7, these are my two numbers. I'm going to calculate current ratio. The top number is 595, my bottom number is 450,000. Here I'm going to get 1.44 and we are going to get 1.32. So that's my first ratio. My second ratio they're asking us to do is debt to equity. So when we're doing debt to equity, my debt goes at the top, my equity goes at the bottom. When you have a debt, you have a current and you have a long term, so you have both. So let's see if they told us in the question, and then we can pick up the numbers from there. We were told we are told our current liabilities are 390, our total liabilities are 1090. So we have current and a long term. They all together is 1,090,000. My equity, when we do that, my equity for that particular year is 215. So then what do I get? I get 5.07, and then I'm going to go to year 7 and I'm going to do the same thing. The reason we're doing both years is we have to do some type of a comparison. When you do a case analysis, that's what you're doing, comparing some of the ratios. So at the top we have 1310, at the bottom we have 240,000, and what do we have? We have 5 point equal to 5.46. So my ratio is 5.46. Going to next, we have, it's called return on average assets. So it says return on average assets. When they say average, means beginning and ending divided by the 2 to get the average. So let's see return on average assets. When you are talking about a return, first of all, it will be shown in a form of a percentage. So what we are looking for is, we are looking for an income. The formula is income before interest and tax divided by your beginning assets plus your ending assets, and then we divide it by the 2. So they told us the income before income tax and expense for the year 6 is 111. 000 when we're doing beginning and ending. So what we're doing is we're doing the beginning. That's when we need our year 5. Our beginning is your beginning total assets are your 1,460,000. The ending is 1,305,000. I take my 1,460,000. I add my 1,305,000. I divide it by 2 to get my average. And then what we're doing is we have to multiply this by 100. The reason we're multiplied by 100 is because it's a return. Return is always shown in a percentage. So I got 8%. So going further to the 7, my income before interest and tax is 130,000. I divided by my beginning is 1305 assets. My ending is 550. 1,550,000 divided by 2, multiply by the 100, and what do I get? I get a ratio. My ratio will be 9.1%. Now going further, what we need is doing the next one is return on average equity. So return on average equity. So that's our next formula, our ratio to do return on average equity. When you have that, our formula is my net income divided by my average equity. When we think of an equity, my average shareholders equity, here is your shareholders equity 410. That's my beginning and that's my ending. So my the formula is average equity. When you're doing average, you have a beginning plus your ending divided by 2. So let's do that. Do I know my net income? Yes, my net income is given to us. My 45,000 divided by your 410,000 plus your 215,000 divided by 2. And what again is a return. I multiply by the 100. What do I get? I get 14.4%. Going further, my net income for year 7 is 65,000, and this is my return on assets. Then we take my 215, I add my current year's ending equity divided by your 2 and multiply by the, I think I have an extra 0, is 240. No, I don't. I multiply by the 100%. What do I get? I got 28.6%. So these were just the ratios that they're asking us to do. Now we have to explain whether liquidity, solvency, and profitability looked better or worse in year 7 compared to the 6. When we're talking about these ratios, my first ratio, when we think of it, when we think of a solvency, when we think of a solvency, we're looking for the current ratio. When we're looking at it, current ratio, and we are also when we're looking at liquidity. So this is my liquidity ratio. So we have a liquidity, so that's what we're comparing. When you're comparing it, my year 6 was 1.44 and my year 7 was 1.32. So what happened? Did it go up or did it go down? I saw my liquidity ratio went down. If it goes down, it is a worse. So it is a worse. The reason for that is my liability is increasing. My liability is increasing, so they are in worse situation. So my second one that we are going to look at is my solvency. When you're talking about solvency, we are talking about my debt to equity ratio. So we are when we're looking at solvency, we are looking at solvency. We're looking at debt to equity ratio. We wanted to know, did it go up or did it go down? So in this case, it went up. If it goes up, is it better or worse? So if it goes up, it is worse for us here, because the reason for that is that our debt is more compared to our equity. So our debt is more compared to our equity. My next one is profitability. Profitability is when we are taking a ratio and we're comparing it on the, it's related to the income statement, and the balance sheet combined. So with this is my, both are my profitability ratio. When you're looking at the first one, the first one, my year 6, my return on average asset was 8.0, and my return on equity was 9.1. It went up. If it went up is a good thing, and it is a better. So they're asking, is it better or worse? So this was the return on average equity, 14.4%, and this is 28.6. So it went up, and if it went up, it is a better for us, not for us, for the company. So that's what you're looking at it. Now this was our first problem that we did. Now we're going to do the next problem. Our next problem is problem number 1.8. It has a lot of things in it, and then it is connecting to your intermediate accounting, or we call it financial reporting 2. So that's what it's related to. So that's what it's related to. So we're going to take this question, and we are going to do a schedule. And what the schedule they want you to do is, the company will be moving from ASPE to IFRS. If they're moving from one principle to another principle. So in this case, it is a private company. If it's a private company, they will be following an ASPE standard. If it's a private company and they wanted to go public, of course, they needed to follow IFRS. So that's what they have to do. So what they have to do is they have to convert their income from ASPE to IFRS, or they have to do both. They have to reconcile both their net income using ASPE and net income using IFRS. So let's see what the question is asking us to do. They're saying to prepare a schedule to convert the net income and shareholders' equity from preliminary financial statement amount to the amount under ASPE and IRF. So what we have is, we have an ASPE and we have an IFRS standard. So we have a net income, and that is preliminary, and we have to make an adjustment to that net income. So that's what you are going to be doing, and to both net income, and we're going to be doing it to the shareholders' equity. So what happens is the standards are different under the both, and that's why our net income will be different under both. What we're going to start off with, preliminary financial statement amount. Financial statement amount is my net income. So let's see if the question told us what the net income is. They're saying that since it planned to go public in the next 3 years, 3 to 5 years, considering changing IFRS to the current year, it wishes to adopt the policy that will maximize the return on equity based on the draft financial statement prepared according to the ASPE. The net income that they prepared was according to ASPE was 409. So what we're doing is we're converting our ASPE net income to IFRS. So we'll start with the same number for both net income. So then what happens is that we needed to reconcile that current shareholders equity, and these are some of the changes that they want you to do. So these are the 5 changes. So what happens in the first one is you have a loan, and that loan is impaired. So if loans are impaired, what we have is we pay interest. So there's two interest rates, original rate versus the market rate. So we have a market rate and the original rate. We needed to know what the both rates are. So we're going to connect the one to the impaired loan. So see what they are saying and what do we do that. One of the here Harmandeep's that debitors is in a financial difficulty and defaulted is on the loan. So this is chapter 13 of volume 2 intermediate accounting. That's when there's a default happens. The accounts balance on the loan receivable at the end of year was 240,000 as a full settlement. So what they did is they owe us 240,000, and what do we get from it? What we do, we get interest from them. So that's what we do, we get an interest from them. So what we needed to know is the present value of that loan. They said Harmandeep agreed to accept 5 annual payments of 59,000. So the payment that we did is 59,000. So we're going to N is your 5 because there's 5 equal payments. The original interest rate is 11% and the marker rate is 9%. So when we think of an ASPE, we're thinking of when we're thinking of is a marker rate. When we're thinking of a marker rate, or we call it IY, we're thinking of a 9%. We have a future value that will be 0. You're going to compute your present value, and you are going to get a number. Your number will be 229489. But when you think of IFRS, we think of the rate is the original rate. So my payment is going to be 559,000. My N is 5. My IY is 11%, and I'm going to compute my present value, and I'm going to get a different number. So the number that I am going to get is 218058. So that's what it is. So the loan that the actual loan was 240,000. Under the ASPE, the present value of the future cash flow is 229489. So there is a difference between the both. And what is the difference? This is the we call it impairment loss. If it's an impairment loss, it goes on to your income statement. Your impairment loss under the ASPE is 1051. The impairment loss sits on your income statement. If it sits on my income statement, I need to adjust for my taxes. So loss is treated like an expense, and what I'm going to do is impairment loss, I need an after tax. If I have an after tax, I'm going to look at it. What is my income tax rate? My income tax rate is, did they tell us what my income tax rate is in this question? What tax bracket are we? I did not see it somewhere, but let's read it a little more. Oh yes, I see it. The income tax is 40%. So 40% is your tax. My after tax loss will be 1 minus the 40, which is going to be 6307. So that's the loss. So if I were to go under the IFRS, my original loan was 240, and my present value of your future cash flow is 218058. I take the difference between those two, get my impairment loss. My impairment loss is 21942, and we're looking for, this is the impairment loss. But I am adjusting my net income, so I will adjust only the after tax. So I take 21,942 multiply by the 60%, it will give me 13,165. So that's the impact of this impairment loss on my income statement. So that's what the impairment loss will be. So I'm just going to do I should have done this at somewhere else, but now I'm just going to erase everything. So you could the adjustment that I have to make for the impairment impairment loss on the loan will be, here will be 6307, here will be 13165. So I'm going to erase this. You can also go back to the video and then see, watch the video again. So this one was my first one, so we dealt with it. Next one is my interest. When we think of an interest, as we like to expense it, where IRF wants to capitalize it. So there's two methods, capitalizing it or expensing it. ASPE prefer to expense it, and where IFS prefers to capitalize it. So let's go to my interest and see what we are going to do. That is my number 2. We are looking at my interest cost. I'm just going to put it here. So what we have is we have to connect the interest cost to my, I think I'm missing something here. I don't see, I think when I copy pasted, I made a oh no, it is right here. Sorry, I thought I missed it. It is right here. It's the interest cost. So it is right here. I thought I missed it. So I'm going to do here. So what they're saying in the question is that Harmandeep arranged a loan of 980,000. So that's the loan that they arrange. They said to finance the construction of a warehouse, 400. There we have 490, and we have another 490. Altogether our loan is 980,000, but we have to calculate the average. So first thing is, was borrowed on March 1st. So if it was borrowed on March 1st, and where are we going to go to? We are going to go to my next borrowed amount is October 1st. So we are going to go to September. So we call it weighted average interest. So we are going to go to September 30th. How many months are gone by? 7 months. And then we have to take it from October to December. October to December will be 3 months. So that's how we're going to get it. My first loan was 490,000. We know it was for 7 months. 7 divided by 12, and we wanted to know if they told us any interest rate. So the interest that the loan is repayable over the 5 year with the interest rate of 9%. So my interest rate is my 9%. So what we're going to do is, here we have an interest rate of 9%, which is going to be 25,725. 25. That's my first interest. My next one is, of course, I owed 490 for the 7 months, and I borrowed another 490. Altogether our loan is for our construction loan is for 980. Is 3 over the 12 times the 9 months, and then what we get is, we get the 2250. Altogether it is called an accrued interest. So accrued interest, when we think of it, accrued interest, again, interest expense sits on my income statement. Altogether my interest is 4775, and what we needed to do is, we needed to do it after tax impact, because we're trying to adjust my net income. So I take the 4775, multiply by the 60%, and I'm going to get it is we're going to get 28,665. So we are going to look at it, 28,665. So 28,665. So when we look at it, we do not adjust my IFRS income. We only adjust the ASPE, because ASPE does not capitalize it. So we're going to calculate, it is called an accrued interest, and that is 28,665. And then I also have to adjust. Now let's I showed you the numbers. Let's put the shareholders equity at the top too. Shareholders equity under both, under my ASPE and under my IFRS. They told us these two numbers because they told us 3,590,000. That's what we are going to be adjusting. So now I have to also adjust here 6307. If my net income is adjusted, my retained earning will also be adjusted, and that will be your 13,165. So same thing, I'm going to do it here. So that's why I wanted to kill both birds in one stone. So let's do our next one and see what is my next one is, so that we could see what is happening with my next one. My next is actuarial gain and loss. When we think of an actuarial gain and loss, comes with your pension, which is your chapter 9. So let's see what they're doing with actuarial gain and loss. So when you have an actuarial gain and loss, what we have is under IFRS, any actuarial gain and loss goes through your OCI, and where is any gain and losses will go to your net income if the company was following an ASPE standard, if there was following an ASPE standard. So let's see what is happening with it and see what adjustment we needed to make. We are going to go to my actuarial gain and loss. Harmondeep instituted a defined pension plan where the pension plan benefits are defined. The first actuarial evaluation, which is done on year 5, so they do it every 2 years, indicated the actual gain of 16,305. So if it's a gain, what will happen? It will increase my income. So it will increase my income. So what happens is that under the ASPE, it is recognized through a net income. If it's an IFRS, this gain is recognized through the accumulated other comprehensive income. So now how much is my gain? My gain is 163,500. My after tax gain will be 60% of that, which will be 98,100. So that gain will be 98,100. So again, we needed, it's called an actuarial gain slash loss. If it's a gain, you will be increasing your income. If it's a loss, you will be decreasing it. So in this case, it will be 98,100. I needed to adjust it if it was a because they don't follow, they don't do, everything goes through the net income. So now if I were here, 98,000 will need to be adjusted. 98,000 will need to be adjusted. IFRS already follows it. We don't need to do any adjustment. So let's go to my next one, complex compounded financial instrument, and it is goes with chapter 16, where you have a conversion. Your debt is converted into preferred share or common shares. In this case, what we're doing is we have a book value method or a residual value method, and then what we needed to do is we needed to say what if they were conversion, what will be the impact on my my income statement. So let's look at my compound financial statement. They issued bond for proceeds of 1,800,000. So the proceeds was 1,880,000. The bond is converted into common shares at any time next 5 years. So bond can be converted. We learned that what if the bond was converted, and the bond will be worth 1112000. So first of all is it's a value of the conversion option. So the option will be, the value of the conversion is $68,000. So that's the value of the conversion. What if this bond was converted into common share? The impact of on the equity will be your 68,000. So the impact on the equity will be 68,000. There is nothing happening with my income statement. So I needed to do an adjustment of 68,000. There will be no after tax impact because the after the this option sits on the on my statement of financial position, which is my balance sheet. So I'm going to put it in here. We are going to do an adjustment, and this adjustment is for 68,000, and that 68,000 will be adjusted. And when we adjust it, we are going to adjust it. We are only going to adjust my my equity for equity. So we say equity portion of the convertibles. There's no impact on my net income, but there's an impact of 68,000, and that will be an increase impact of 68,000. Let's go further and see what we could do next with our income tax. Again, this is chapter 18 for your deferred taxes. If you haven't mastered that, go back to my video for chapter 18 for volume 2, which is your deferred taxes. There are about 4 or 5 videos. If you wanted to refresh your memory, you can watch the chapter video. So what happens in this case, Harmandeep's income tax rate has been and is expected to continue at 40%. Assume the adjustment to the accounting income. So my accounting income is different from the taxable income. We have two differences. One is a permanent difference. The other one is my temporary difference. So they said the above items are fully deductible or taxable. So if they're fully deductible, that means it is my reversing difference, or we call it temporary difference. We are going to have something deferred tax asset or deferred tax liability, or we call it future tax asset or future tax liability. So now we have two things are going to have. If you have a future tax method using it, so we are going to have an expense or a liability. So we needed to know the impact. Since it's a tax, there's no after tax. So first what we needed to do is we had a liability of 309. The liability now is 358. So the difference between the both is 49,000. I need to do an adjustment, and this is my we call it future tax liability. Future tax liability, and it is going to be if you have a liability, you have an expense. So we have when you do an entry, expense and a liability. So my liability increase, if it increase, my expense also increase, but we don't take taxes over the taxes. So what we are going to do is we're going to do an adjustment for 49,000 under the SP, and we're going to make an adjustment for 49,000 under here. But when you think of a shareholder's equity, we are thinking of the full amount. So what we're going to do is we are going to adjust the 358 for the full amount, and this is 358 for the full amount. So what we're going to do is now we're going to calculate what is the income under ASPE and what is the income under IFRS, and same thing with shareholders equity. And what we call this is we call this a revised value. So this is my revised value, that is 42128 346,835. Here will be 3363128, and we have 3384935. So these are the values that I got. So this was question number, it's a bigger question. It was a question number, problem number 18. So this was the 2 questions. This is representing the chapter. The both problem represent the chapter. I'm going to stop here, and I'm going to record another video for I'm going to go through each chapter for the advanced accounting. Thank you so much for listening to me. Don't forget to subscribe to my channel, and don't forget to write a comment or liking my videos. See what you like, what you want me to record more, and how you want me to improve the channel. Thank you so much, and take care, and bye for now.